Die Geldmeisterin. Der Finanzpodcast.
So some of the countries that I still like, Egypt, Nigeria, Ghana, Latin America, we still like Argentina, Sri Lanka, that's going through a restructuring literally as we speak. In corporate, some of the higher yielding sectors would be the Indian renewable energy sector.
Ja, die Stimme, die ihr gerade aus London zugeschaltet gehört habt, gehört Uday Patnaik, Emerging Market-Bond-Experte bei LGIM, des globalen Asset Manager von Legal & General. Ein kompletter Kontrapunkt zur Investoren-Legende Jim Rogers, die ich in der Vorwoche bei der Geldmeisterin zu Gast hatte. Während Jim vor dem Crash in Kürze warnt, nimmt Uday Patnaik als Emerging Market-Bond-Experte volles Risiko. Er setzt gerade jetzt auf Dollar-nominierte Schwellenländer-Anleihen und das, obwohl ein hoher Dollar und geopolitische Krisen doch normalerweise gegen riskante Assetklassen sprechen. Sein Argument, die Ausfallraten sowohl von Staats- als auch von Unternehmensanleihen aus Schwellenländern seien derzeit nicht höher als bei entsprechenden Bonds aus Industriestaaten. Man bekäme dafür deutlich mehr Rendite bei nicht unbedingt höherem Verlustrisiko. Das könnte aber dann schon in diesen Staaten stärker ausfallen, wenn die US-Wirtschaft und damit die Weltwirtschaft 2025 doch noch in die Rezession rutschen sollten, wovon Uday aber nicht ausgeht. Apropos Rezession und Börsencrash. In der letzten Woche verriet Starinvestor Jim Rogers, dass er jetzt doch überlegt zu shorten, eben weil ein Börsencrash unmittelbar bevorstehen sollte. Dazu passend erhielt ich folgende Anfrage eines Hörers auf die letzte Folge mit Jim, die vielleicht für alle anderen Geldmeisterinnen auch interessant sein könnte. Ist Shortgehen das Gleiche wie sich mit Puts abzusichern? Die Antwort ist nicht ganz. Zwar setzt man in beiden Fällen auf fallende Kurse und profitiert von Kurskorrekturen. Doch beim Shorten durch Leerverkäufe leiht man sich tatsächlich schwächelnde Aktien aus, um sie zu einem späteren Zeitpunkt, wenn sie inzwischen im Preis gefallen sind, günstiger zurückzugeben und dabei die Preisdifferenz als Gewinn einzustreifen. Die Gefahr ist nur, dass die Rechnung beim Spekulieren nicht aufgeht, die Aktie also steigt statt fällt und es zu einem Short-Squeeze kommt. Ich muss mir also die Aktien dann zu einem höheren Preis zurückkaufen, um sie zurückgeben zu können, und damit befeuert man den Preis noch automatisch. Wenn ich hingegen mich mit einem Put gegen fallende Kursen absichere oder hedge, kaufe ich keine Aktien, sondern setze mit Hebelprodukten wie Optionen, CFDs oder Futures nur in Anführungsstriche auf die Kursentwicklung. Put-Optionen geben Anlegern das Recht, innerhalb eines bestimmten Zeitpunktes, nämlich zu einem vorab festgelegten Preis, zu verkaufen. Und bei Put into the Markets geht man also von fallenden Kursen aus, während man bei Call-Optionen von steigenden Kursen ausgeht. Apropos, wenn ihr euer Börsenwissen von Anfang an auffrischen bzw. grundsanieren möchtet, dann lege ich euch den Schwesterpodcast der Geldmeisterin, die neue Börsenminute, ans Herz, die Woche für Woche in wenigen Minuten ein weiteres Puzzlestück des Kapitalmarkts erklärt und dich so bei deinem Vermögensaufbau bestens unterstützt. Viel Hörvergnügen bei der Börsenminute oder auch bei der Geldmeisterin, speziell dieser Folge über den Sinn und Unsinn von Emerging Market Bonds in Zeiten wie diesen, wünscht euch Podcast-Host Julia Kistner. Yeah, Udi, thank you for being here. I'm really very proud to have you on Geldmeisterin. Would you please briefly just introduce yourself to the podcast audience? What are you doing at LGIM?
Yes. Hi. So my name is Uday Patnaik, and I'm head of emerging market debt at Legal and General Investment Management based in London. We manage money for primarily institutional clients, but wholesale as well, based out of London. And we do have offices and resources in Hong Kong and Singapore as well. Mm-hmm. We invest primarily in hard currency debt. That means primarily dollar-denominated debt. We invest in investment grade, high yield, sovereign issuers, and corporate issuers as well.
And how do you define emerging markets? Is India or China for you still an emerging market, for example?
Yes, it is. It's interesting, actually, that there's no universal definition for emerging markets. So it really is quite dependent on, for example, if you're using a definition from the World Bank / IMF, or if you're using a definition that's used by various index providers like JP Morgan or MSCI, and so forth. But, generally speaking, the way people define an emerging market country in a broad sense is basically based on your income per capita. Mm-hmm. Okay. Now, if you look at, for example, the JP Morgan Sovereign Index, which is what a lot of people use as a benchmark, their income per capita, for example, has to be over roughly 23,000 US dollars to not be emerging markets. So anything under 23,000 or so dollars would be considered emerging markets. Mm-hmm. On the other hand, if you look at the World Bank definition, if your income is roughly over $14,000, that would be considered, a high income, right? And not necessarily defined as emerging markets, but there's not a precise definition. But it's interesting, the question you asked is because many emerging market countries have a lot of the characteristics of advanced economies, while still having these elements that maybe we, as an income, for example, per capita, which is lower than, let's say, in Europe, which still has characteristics of an emerging market.
And are these emerging markets especially interesting, which have this appearance of developed markets, or is it the pure player you're looking for?
Yeah. So what's interesting and what makes the asset class, for me, particularly interesting to invest in, that the spectrum of what's included in emerging markets will include very fragile countries, let's call them. So, it could include countries, like an Argentina or a Ghana or a Zambia. That's on one end of this. Off the spectrum, all the way to including countries like a Chile, for example, or a Mexico, or a Peru, or an Indonesia, or China, which is at the other end of the spectrum, i.e. being investment grade rated. So today, we have credits that are sub-investment grade or even in default, right? All the way up to, single A rated, double A minus rated credits like a Chile or, China. We have that entire spectrum to look at as an investor.
As I always say, bond investors need a lot of experience because the field is even greater than in the share side. So why should I invest in emerging markets, and especially in the class you are situated in, the emerging market bonds?
Yeah, I would say there are quite a few reasons. So I've been investing in emerging markets for over 30 years, right? So over 3 decades. And, as an example, when I started investing in emerging markets, we used to trade the loans that were in default. Right. So these were often loans that had been defaulted in the 1980s, commonly referred to as, quote unquote, the lost decade. And in the very early 90s, these loans started to trade between different banks, for example, in the U.S. And eventually these loans were then restructured into bonds, and then indices started. You had sovereign issuers and you had corporate issuers. The local markets became deeper, and so forth. So today, the investable universe in U.S. dollar equivalent is over $27 trillion.
Oh.
So this is larger, for example, than the U.S. Treasury market or the U.S. high-grade market, multiple times larger than U.S. high yield, for example. Right, and European investment grade, and it's growing very, very fast. So it's a very it's an expanding market which includes both investment grade, sub-investment grade. So there's a lot you can do. First of all, as a client, depending on the volatility, but underlying is for why invest in emerging market these countries, and today, for example, about 50% of global trade is done with emerging markets. Is emerging markets oriented. About 50% of FDI is emerging markets oriented. Today, emerging markets, they're the growth driver of the world, right? So, if you go back 15, 20 years, that wasn't the case, right? It was the advanced economies. So today, about 65% of the growth impulse comes from emerging markets, and so forth, right? And, so it's a rapidly growing part of the world economy. It's in dollar terms about 50% of world GDP. On a purchasing power parity basis, it's roughly speaking about 60% of world GDP. And one thing that I've noticed, marketing in Europe and the UK is there are quite a few clients who virtually own zero in emerging markets fixed income, even though it's between 50 to 60% of world GDP, depending which metric you're using in dollar terms or PPP terms. So to me, that doesn't, and it's a growth driver. So to me, that doesn't really seem, appropriate in terms of a weighting or an exposure.
So I just get it. You can't exclude such a huge part of the cake. You have to be in there, of course.
Yeah.
But why is it the time to shine for emerging market debt now? Because you just told us that you are primarily invested in emerging market debt, which is denominated in dollar. And the dollar is quite strong right now, and it will be in the next month. I don't know, of course, but I guess it will stay strong, at least at the beginning of Trump's presidency. So why should I invest right now in emerging market debt?
Okay. So, in emerging market, there are various sub-asset classes. One is hard currency, which is what we do. There's also local markets, right? Now, this year, for example, hard currency emerging market debt has returned, roughly speaking, just over or at around 8% in dollar terms. Local markets in dollar terms is small negative return. Okay. When you're investing in hard currency, sovereign or corporate debt, as an investor, you're not directly taking the currency exposure. So whether it's in pesos or rupiah or rupees or renminbi, unlike in local markets where there are two components, there's the local rates component and the FX component, whether it's versus a dollar or the euro or whatever, base currency. In hard currency, it's really more the rate spread component that is influencing your return. Now, yes, I agree with you that I do think, at least initially, perhaps first half of the year, the dollar will remain strong as it has been since, especially since the Trump win in November this year. But which is why I would recommend hard currency versus local. Okay. So then it comes to, but are you being compensated for it? Well, right now, if you look, for example, at the hard currency indices, just as a benchmark to give to you, the hard currency indices, the yield right now, again in dollars, is about 7.7, 7.8%. That's a very attractive yield. Now, we're an active manager, and we would like to think, as we have done, we would give a nice alpha generation on top of that index return. So I guess my point would be is, given that yields in the U.S. are relatively high, at least what we've been used to over the last 5 to 6, 7 years, that if you're seeing yields in hard currency without taking the local currency direct risk of close to 8%, those are equity-like sort of returns potentially that you're getting in a fixed income instrument.
Now I'm a little bit confused because everybody says high yield bonds and the spreads would be too small. They wouldn't compensate the risk. So you say in hard currency emerging market bonds, the risk premium is attractive right now.
It is overall, but again, let's break down. So we've talked about hard currency and local currency.
Yeah.
In hard currency, we can break it down into two subcomponents there, into investment grade and into high yield. Now, the sweet spot is actually high yield sovereign debt right now. Okay. The investment grade debt is what I would say is relatively perhaps expensive to /fair versus U.S. investment grade if we were to look over the last 10 years. Okay. So, but the sweet spot, so when I'm mentioning that 7.8% yield, within that, what would interest me more today, and I'll get into why, would be the high yield component of that. So, countries if we're talking sovereigns, countries like, Ghana, for example, for the time being, still Argentina, countries like Egypt. Okay. Whereas countries like a Qatar, as an example, or an Uruguay, which is also investment grade. Yes, they are relatively tight, but my view is that just like this year where, high yield has significantly outperformed investment grade and hard currency has outperformed local currency, I think at least for the next few months, we'll see this continue for the next few months because we're in a situation, in my opinion, where you still have reasonable global growth. There's still resilience in the U.S. economy. Okay, EM economies generally are doing well, right? If we look at, for example, default rates, that this year there were in the sovereign space, there were virtually no sovereign defaults, though there was perhaps a technical default in Argentina, but they paid. Next year, we don't see any sovereign defaults. In terms of corporates, we see the default rate in corporate high yield at the lowest level, well under 3%, the lowest level in perhaps 5 or 6 years. So we're in a situation, at least, where, again, it's a bit of a bifurcated world where EM growth, generally speaking, is doing well. U.S. growth is doing well. European growth, not so well. But overall, we're talking at around a 3% growth rate for next year. The EM developed world growth differential should still be at around 2.5%, which is reasonably strong with a falling default rate. And in this scenario, unless we believe that the U.S. were to go into a recession, or right now it looks like no landing scenario for the time being, at least. It does look like a reasonable environment for EM high yield, both sovereign and corporate versus IG for the time being.
How come that the default rates could get down? What makes it that the emerging markets could manage better their defaults? Did they get less dependent on the dollar, or what did they do?
Yeah, I mean, that's a very interesting question. And what you'll find is if you look at the various, we use in fixed income the JP Morgan indices. Okay. And if we go back over the last 15 years, 20 years, right, you'll see a general improvement in the credit quality of the indices. So as an example, the JP Morgan corporate index is now investment grade rated, right? That wasn't the case, if you go back 15 years, right? Similarly, the sovereign JP Morgan index is literally on the verge of being investment grade rated. Again, a very different scenario than if you went back to when I started my career. So, why is this? I think part of it, when you go back to, as I was mentioning, sort of the genesis of this sort of asset class and investing in this asset class. In the 1980s, what happened? Well, it was the classic where you had sovereigns, emerging market sovereigns, and corporate issuers in emerging markets. They were issuing, for example, in dollars, but of course your tax base is in a different currency, right? It's in a local currency. And when you have, bouts of dollar appreciation and your liabilities are in that currency, but your revenues are in a different currency, and suddenly, you have this massive mismatch. Well, you default, right? They defaulted. The debt burden was way too high, right? And over time, many of these countries learned that, well, if you have this mismatch, this is a situation that can very well happen, right? Now, as we progress, as this asset class has increased in size, right? Remember, it's over 27 trillion investable universe, right? These are JP Morgan data as of year end, by the way, last year, right? It's not the total, that's the investable universe. The largest component of this, and let's say about $23 trillion equivalent, is the investable universe of EM local markets, right? So these would be countries, right, that are issuing for their general needs, but they're issuing in their own local currency, and they're building out their local yield curves and the depth of their market, right? So many of these countries over the years also, they realize, like, look, as we continue to grow, if we were to borrow, whether it's in dollars or euros or yen, etc., and, if you get bouts of significant weakness relative to that base currency, you could have a funding crisis. So they developed their own local markets, significantly. And I think also, so there were learning experiences, but there were other very important learning experiences. The global financial crisis, which was not as a result, of EM, right? That was started with the U.S. housing, right? But again, you had at the time the Fragile Five during that period. But again, a lot of these countries, whether it's India, Indonesia, they realized, okay, this is a weakness, right? That when you have these current account deficits and you're trying to fund these and you're in a crisis, well, again, this could be problematic. So, look, in my opinion, I think over time, many of these countries from the 80s, 90s, 2000s, and so forth, many have learned that, yes, it's important to be able to have a variety of funding sources. And yes, whether it's in dollars or euros in international bonds, what I do, it's important. But that's one source of funding. You should also have access to the loan market, right? You should have access to the domestic loan market, the domestic bond market. So I think this is one of the reasons, or several reasons, I should say, that I pointed out, why you've seen this general improvement, in sort of the rating of these indices, and in generally the improvement of many countries. I remember the days when I first moved to London, and I was with an investment bank, and I was hired to set up the Eastern European trading desk. I used to trade Bulgarian loans, defaulted loans, Polish defaulted loans. And there, you had an anchor of the EU, right? So you went through the restructuring, you had an EU anchor. Okay, you have certain fiscal deficits, targets you need to meet, certain, reforms you need to do, independence of central bank and, with the government and so forth, right? And so, you had anchors in Europe that also helped. So, can you imagine trading Polish loans at, 20, 25 cents on the dollar, right? Defaulted loans. And now you look at Poland and, what a success story, right?
Except Ukraine.
Yes. Well, there are situations that are always challenging.
Yeah.
I think there are about 193 countries in the world, and
really?
something like, and I think about 155 of of them would probably count, roughly speaking, as emerging markets. So look, but that's the opportunity as well, right?
Yeah.
That, you have these countries, and the hope is over time, whether it's a Zimbabwe or Ukraine, which has just gone through the restructuring, etc. And perhaps Ukraine will have that European anchor, right, an EU anchor as well. And would I be surprised that once this war at some point ceases, perhaps there is this long-term whatever entry for Ukraine in the EU, that over the next 10, 20 years, Ukraine can, perform significantly better. It wouldn't surprise me at all. In fact, I would expect it.
Yeah.
I would expect it with that anchor.
In the last few years, especially since the COVID crisis, the emerging market have been able to catch up very, very strong economically and also on the financial markets. What is the reason? Is it just because they were younger and didn't have so much debt?
Look, I found that, and again, in my experience, what happened during COVID and how many emerging market countries responded, was unique. And I felt that the responsibility that they showed, I hadn't seen before, right? I'm saying generally speaking, right? That, look, they didn't take rates to zero to negative. And by the way, that's not because many Western economists were saying, I still remember to India, saying, look, why are you worried about your budget deficit? Just take rates to zero or negative. And they didn't. They were very calculated with, how they lowered rates, as were, other countries. And post-COVID, as a result, they didn't have to raise rates as rapidly as, let's say, the Fed in, 2022, and whatever it was, 425 basis points, right? Increase in rates, or as, the ECB, which was a shock, a real shock to the system. So they were responsible with the way they reduced or they lowered rates. They did their fiscal during COVID. I thought, in many cases, much more responsible than G7 countries. And post-COVID, as a result, as the world started to return back to some sort of normalcy, they didn't have to go to the extremes the other way, right? So when they had to raise rates, they were ahead of the curve, EM countries, well ahead of, Swiss National Bank, the ECB, right, the Fed. So they raised rates ahead of time. And then they were also cutting before, we've seen, the latest cuts with whether it's the Fed or Bank of England or ECB and so forth, right? They were ahead of the curve, So generally speaking, especially, the larger EM, but even, some of the smaller countries, I felt that they were actually in general quite responsible. And look, that's reflected if you look today. So it's not just an opinion, it's quantitatively, if you look at upgrades versus downgrades.
Yeah.
Right. So over the last 12 months, there are about 70% ratings upgrades or outlook upgrades versus downgrades. Okay. And as I mentioned, the default rates and so other, if we put aside China real estate, now the other thing I would mention is they also did have a lot of support from multilateral agencies, including, the IMF, World Bank, and so forth, right? They did have that support, but one of the reasons they got the support is because they were doing the right thing, right? So, these multilaterals don't just give out the money.
No.
It's like you have to be doing, from a budget perspective, for fiscal, so forth. You have to be doing the right thing. And, so we do have a lot of support that the countries are doing the right thing.
So they were clever. So to get at the end to the new shooting stars, you also are a long time in the business. When Goldman Sachs analyst Jim O'Neill published the concept of BRIC, the idea of investing in the 4 fastest growing emerging markets, which means Brazil, Russia, India, and China. 2 of them performed very well, 2 of them less. Are these 4 countries still the engine of the emerging market, or how has the investment strategy changed so far? What are is the emerging market bond strategy right now? Are there other shooting stars? You mentioned Ghana, for example.
Okay. To be fair, China and India, they're not just the engines of EM growth, but of global growth. Probably 2 of the 3 most important, along with the United States. Okay? These are the top 3 contributors of global growth. This year, probably next year as well. Okay. But for me, where I feel going into next year, again, I have a preference, as I mentioned, for high yield right now. So some of the countries, that I still like would be, for example, countries like in Egypt. Okay. Egypt has rallied significantly, but they also have such significant support right now from Saudi Arabia, from the UAE, direct investments into tourism. You're building reserves and so forth. There's Nigeria, we also like. Ghana, we like. Latin America, we still like Argentina. Those are some sovereign names. Sri Lanka, that's going through a restructuring literally as we speak, right? Those are some of the higher yielding names. And in corporate, some of the higher yielding, sectors would be, for example, the Indian renewable energy sector. That's one sector that we like. We also like some, callable bonds, let's say in Mexico. So this would be like Banco Santander in Mexico, callable bonds, instruments like that, where they've always called, even during the global financial crisis. Though we think we're in a generally more benign situation, obviously, than 2007, 2008. In terms of investment grade, so it's interesting with President-elect Trump coming in. We still find Mexico for its rating relatively cheap, and I understand the tariff issue around this. But we can discuss that later. But I tend to believe a lot of the tariff issue will probably be around Chinese entities that are using Mexico more as a backdoor to sort of penetrate the U.S. market. But it's still like Mexico here. There are other credits like Chile, which are more stable as well, which we have exposure to, and so forth. Yeah. Sorry, I would mention one other. Turkish corporate bonds, which are high yield. We're overweight those right now, as well as, you're seeing more of a orthodox monetary policy being implemented in Turkey over the last year.
How important are geopolitical circumstances?
Yeah. So we are a macro top-down investor. And so for us, we're looking at geopolitics, we're looking at commodity prices, even though we're doing hard currency. Yes, we look at the dollar in terms of financing conditions. A strong dollar obviously means tighter financing conditions for EM countries and issuers. We're looking at volatility, U.S. rates volatility, equity volatility. So these are all the various things that we discuss, right? Topics we discuss before we build a portfolio. And geopolitics is critical. And so there, generally over the last year, especially since the Israel-Hamas situation in October last year, one of our largest regional underweights, or actually our largest regional underweight, has been in the Middle East. Okay, a couple of reasons. This coincided also, obviously, with commodity crude prices coming off the highs. So we have a situation where you have this geopolitical tension, and as we know, when there's a war happening, mistakes can also happen, and fortunately, things can rapidly escalate. Okay, and so clearly that was a risk for us. Number 2 is that the valuations were still for many of the countries and credits relatively expensive, so we weren't really being compensated for that risk, right? And thirdly, because oil prices were coming down, and then if you look at certain countries, their break even on oil prices for some of the countries in the region is considerably higher. Okay, than, for example, where Brent is today. So that's been an underweight for us. Generally that doesn't mean every country is an underweight, but generally as a geographic region, it's been an underweight for us.
And it's still an underweight?
It's still an underweight. So we would look to, in fact, this morning, Egypt is a credit we added to, and it's a credit that, as we sort of make it through this, hopefully, that, we would like to add. Another, I guess, underweight for us has been, again, generally speaking, that doesn't mean, every issuer, but has been China. And it's been an underweight due to one of the main reasons, outside of the growth issues, has been the geopolitics and the sanctions issue from the U.S. and the EU, the potential tariffs that started with the first Trump administration, carried on with Biden, and then will follow on. We're all assuming, right, with Trump version 2. So, I mean, that's again generally been in certain sectors in there where we've been just underweight, from a portfolio standpoint. So, balancing the sort of the Middle East underweight, the sort of the China underweight, has been the India overweight. As a beneficiary, especially in the renewable energy sector, that we've liked, has been a bit of a Mexico overweight as well, as a China plus one. Mexico has also been a beneficiary along with India, for example. The Turkey I've mentioned already as a more orthodox policy. You've seen a significant rally in Turkish corporate and sovereign spreads. Ukraine is very interesting. Ukraine over the last few months, we've also been overweight. And again, that's more tactically on a potential ceasefire. Perhaps not immediately a peace deal, but more of a ceasefire where we could see tactically Ukraine sovereign bonds, for example, which have been rallying considerably over the last couple of months, especially post-Trump. We think there's potentially more in that as, we at least get some sort of basis for a ceasefire. So, and that's the interesting bit about emerging markets, that there really are just so many, because it's so diverse and there's so many sovereign issuers, there's so many corporate issuers, there's just so many unique opportunities, right? Yeah. You're not defined by a certain sector or certain geographic region if you're doing global EM.
But still, how long is the duration of your portfolio, more or less?
So the way rates have been trading, right, that it's challenging for me at the time to be overweight duration, I'll have to say. Okay, because what Trump is intending on doing with tariffs, whether you view tariffs as a one-off tax, but in my opinion, the tariffs will be layered on, right? But that's inflationary. If you look at extending tax cuts and potentially trying to do more tax cuts, it's also stimulative, right? More deregulation. I'm not saying this is bad, but I'm just saying that if you read what President-elect Trump wants to do, look, it's stimulative. It's good for growth. Okay, some of the points I would say would be more inflationary than not. Okay, so in that scenario, I have a difficult time fathoming where pre-U.S. elections, where we were pricing in meaningful interest rate Fed cuts, right? That, okay, fine, we have a Fed meeting tomorrow, and yes, I'll go with consensus. Powell does another cut, tomorrow on Wednesday. But thereafter, I think this cutting cycle is going to be quite shallow. Okay. And it's a big if Trump does what he's intending on doing, right? It's because, in that scenario, look, it's stimulative, generally speaking. Now, I know what he's saying on the flip side is basically saying, look, I'm going to cut government spending. Okay, I'm going to slash bureaucracy. We'll have to weigh that, right? We'll really have to see, how that factors into this, right? So, I know Elon Musk came out and said, I can slash $2 trillion off this budget, like snap of the finger. Look, I don't think it's going to be that straightforward, frankly. Okay. So that's why I think you're seeing over the last weeks, you're seeing this increase in rates, right? That what we're pricing in for the time being is a still good U.S. economy, right? That's what we're pricing in. And again, that goes to what we were saying earlier about, the dollar view, hard currency versus local currency. But in that view, right, if you believe that for the time being, as we sit here today, that U.S. growth is generally going to be around 2.5% next year. Some people have it a bit higher. U.S. growth is also generally good for EM growth, right? I mean, it is still the largest, by far, economy in the world, right? At least in dollar terms. In dollar terms, it is not on PPP, right? But on dollar terms, it is the largest economy in the world. And if you're talking about, U.S. growth at around 2.5%, and you're talking about China continuing to stimulate because of their issues, and coming out with all these fiscal, sort of easing and sort of et cetera, so forth. Look, you're in a situation where, global growth is still reasonably good. And I look, Europe, yes, does have issues, but there are other parts that are good. Maybe not great, but they're good. And in that scenario, and especially when you look at inflation expectations, where, generally since post-Trump, people, I think most people at least, are pricing in a slightly higher inflation expectations than they were pre-US elections, right? Maybe by 40 basis points or so. That goes back to the duration. Now, do we get a point where as yields go higher, I don't know what that number is, frankly, where let's take 10-year treasuries, if you do reach 4.40, 4.5%, 4.75%, does it in fact then arrest sort of this momentum in the U.S., right? And globally, frankly, I would at some point, yes. But I think what's happening for the time being is the bond markets are pushing against this sort of recession narrative, right? That we had, or soft landing narrative that we had pre-elections, is pushing against it, and is based on the policies that President-elect Trump wants to do. So now the question will be, let's see what he can do, what's simpler to do and what's not.
I have learned so much from you in the last few minutes or half an hour. I have to come to the end. So my last question would be, a private investor, also an institutional, how much should he wait or she wait in her portfolio, the emerging market bonds, in his long-term portfolio? Yeah,
and I think, obviously that depends, on specific mandates.
Yeah,
but look,
sure.
The way I try to explain to investors, and I was just recently in Frankfurt, I was in Vienna, then I was in Milan. And what I was telling investors is, look, you have to appreciate the volatility, the default rates around investment grade emerging markets is very different than high yield. So if you look at investment grade corporate default rates in EM, it's similar to US investment grade default rates, though you do pick up a spread, yield pick up, right? So the way I like to think about it is, look at it from a volatility perspective, right? So you can't look at EM local market sub-asset class, comparing it to hard currency, sovereign investment grade. It's apples and oranges. Okay, it's just your returns will be different, your drawdowns will be different, the Sharpe ratio, / information ratios are different. It's a different asset class. So, look, what I would say is, depending on the volatility you're looking for and the yield that you're looking for over the medium to long run, is how you would determine how much you would want to include. But I do, as I said, I think having zero, to me, it just makes no sense when it's the growth impulse globally. EM today, it is the growth impulse, so that's not even debatable, right? And it's not just me saying looking forward. I mean, whether it's the IMF and et cetera, it's the growth impulse over the next several years, which is why this asset class has grown significantly, right? Whether it's Asian sovereign wealth funds, Middle Eastern buying emerging market debt, German insurance companies or Dutch pension funds buying emerging. I mean, they're realizing that as well. But I think what surprises people is when they look at the default rates for investment grade versus investment grade, and you look at the spread pickup that you're getting and the spread per turn of leverage that you're getting. And I do think it makes sense for a efficient portfolio to have some EM. But look at it via the volatility versus the return rather than just, it's emerging markets.
Yeah, we will do that. And thank you very much for your impulse to invest into the emerging markets, not just on the equity side, but also that the emerging market bonds are very interesting. Thank you very much and good luck also for 2025.
Thank you very much.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.